Welcome to the Iferia TechCast. I'll bring you all things science, engineering, technology, and innovation. Today's guest bridges the gap between logic and wealth. Meet Victor Idoko, chartered financial analyst and host of the Elevate Your Wealth podcast, and also author of 7 Basic Wealth Strategies. Victor helps analytical minds like engineers, technical professionals, and STEM-driven thinkers cut through financial complexity with actionable strategy. With over a decade in finance, he combines technical expertise with real-world insights to simplify wealth building for those who thrive in precision and systems. In this episode, we'll explore how engineers can leverage their analytical strength to build diversified portfolios, avoid common money pitfalls, and align their financial habits with long-term goals. So, Victor, it's nice to have you on the show. I'd like to ask, many high-performing technical professionals like engineers, even while crushing it in their careers, still feel lost, overwhelmed, or behind when it comes to money. What are the most common mistakes that they make with their money?
Yeah, so very, very good question. I think one of the common things is relating it to their job. I think very technical STEM professionals, because it's science based, it's almost like a yes or no. It's like 1 plus 1 is 2, and it's that way or it's wrong. That doesn't flow into finance and money because finance, there are lots of behaviors that first you need to address, and I like to think about it as part science and part art. So it's definitely not that straightforward. So I think that's why they get a they get a little bit frustrated as to why it isn't making that sense, why your investment isn't giving you that consistent 10% every year. Why does it go up and down? So all those things can be very confusing as well. So I think that's why, they might be very good at your jobs, which as I said, it's science based. So it's like 1 plus 1 is equal to 2. But in,
Yeah,
in, in finance and in money management, it's, yeah, sometimes 1 plus 1 is equal to -2.
all right.
So yeah.
How exactly can these technical-minded professionals who think or who believe or who have been made to actually understand that 1 plus 1 is equal to 2, how can they embark on this journey to elevate their wealth?
Yes. So one of the things the best way I can relate it is by them thinking about things in probabilities. I think probability is a very good mathematical concept that they can apply to finance. And if we think about investing, it's actually totally about probabilities. However, the probability of making money is a lot higher than most people expect. And if they go into an investment at the wrong time, that probability may look like it's totally out of skew or out of whack or out of the average. So that can really cause them to not want to do it again. So I think a good approach is one, look at things in terms of probabilities. What is the probability of you making money in a diversified investment portfolio? I'll say, look, it's about 95%. There's only a 5%
Oh,
chance that, yeah, yeah. In
that's
fact,
a
I'll
great
even say
number.
higher than that. Yeah.
Wow.
And and that probability increases as the amount of time you spend in the investment increases. Okay. So if you see now, they start to really understand, okay, how investments work, because the probability of you losing money in the first year of investing in, I'll just say, international stocks and a diversified portfolio is almost 70%. Okay, but that probability increases as time goes on. Sorry, the probability of you making money increases as time goes on. By the time you get to the 10th year of investing in a diversified investment portfolio, there's a 99% chance you would have made money. Okay, so there's still a slight probability there that you won't make money. So I think that's the key thing as well. People need to think about these things in probability terms. And I think another thing as well, they need to approach it as more art. Okay. And the art is, okay, well, what do you pick to invest in? What are the things you can do to reduce the risk. That is more about the, I would say, art side of it. And I guess people's personalities and people's biases. Because if you grew up in a family that always hated investments or talked negatively about those that made money or those that had investments, subconsciously that would be affecting the way you would have and make your own investments. So that's very important as well. And that part as well is definitely definitely more art than science.
All right. So I think the catch here for me is that uh, building wealth or making money is more of uh, it's like a function of probability and time. So in science or engineering, I will call function. So I don't know if that's like the catch from what you explained.
Yeah, yeah, I think definitely helps as well. Yeah, probability, sorry, function of time, and I'll say function of behaviors as well. I think that that's a key
Hmm.
aspect because why are some people more successful investing than others? I think if you approach it with an analytical mind, saying there is a way, I will find a way, that's better off than okay, well, this doesn't work, I'm out. So I guess you can look at it as a function of a few things. Yes.
Yeah. So you mentioned some really crazy percentage being the probability of making money. So even I myself, like it was really like surprising for me because I never thought like the chances of making money could be that high as you just mentioned. So I'd like to ask,
Okay. Interesting.
is it is it actually that particular case for everyone who just going to these journey to elevate their wealth, or is there a particular procedure or process they have to follow for that percentage or probability that you just talked about to apply to them?
Yeah, so very good question. I think, you know, one thing with that statement, a few other things that I can mention that would give people more perspective. I mentioned with a diversified portfolio, okay? So one of the key mistakes people make sometimes when they're investing is they go to buy one stock or one company, okay? Now that probability will change if you buy one stock or one company because it's not a diversified portfolio. A diversified portfolio is a portfolio that has, look, I would say, and I'll use an index an example. It has the top 3,000 companies in the world. Okay, so what is the likelihood of the top 3,000 companies in the world all failing at the same time? Very, 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 very low. In fact, it's almost impossible. So that's why when you look at those percentages, you need to give more context or more meaning to everything else. And that's why I said diversified portfolio, because sometimes what people do that is a mistake is they go invest in just the one company that you've heard of that they think is going to do well, and then it doesn't do well. Okay. So when we talk about investing as well, the probability of making more money in a certain stock is generally higher than a diversified portfolio. So it's one of those things where you want to balance the risk and the return as well. So that's why I would say most people tend to um, not make money because they buy one stock or they don't wait enough. So going back to that function we spoke about as to investing is a function of time and a few other things.
Hmm, that's great. That's great. So you talk about a diversified portfolio. Could you just give us an idea of like what a diversified portfolio would be? How you actually diversify your portfolio, the things you put your money into to have a diversified portfolio.
Yeah, so the best way to think about it is not putting all your eggs in one basket. Okay. And if you think about a basket, and I know the Nigerian way is actually crates of eggs. So, but if you think about a crate
Yeah.
or a basket of eggs, it's not just the one egg there. You have multiple eggs, and you can think about these eggs as companies. So the more companies you have in a portfolio, the more diversified you are. Generally, in a portfolio, you have it broken down into different asset classes, and then within an asset class, you have different investments. An example of an asset class is stocks. Okay, now within stocks or equities, you would have different companies. So think about the top 3,000 companies in, I'll say, the US. That is a diversified portfolio within international stocks. Okay. Now the other asset classes as to property, fixed interest. So now you need to diversify to ensure that, okay, well, you're diversified across the different asset classes and within each asset class as well. So there's a bit of understanding that really comes into that. And I've studied this for for the past 17 years. So I guess to me it comes very easy to explain these things. While as for someone else that has studied, I'll just say physics. It's the knowledge they'll have in physics. I would be a beginner, and so the knowledge I have in finance, they are a beginner as well. So I think that's the thing to be aware about as well. It takes time to
Yeah.
fully understand all these things.
Yeah. So many engineers often focus on maximizing their salaries. What's one assets or investments they are overlooking that could actually make a big difference?
Yeah, so the your ability to work and earn money is actually your most valuable asset because without your ability to work and earn money, you won't have anything to save and invest. So while you are focusing on your human capital, your ability to work and earn, you should also ensure that, okay, well, you're translating or moving most of this human capital into financial assets. And that's where your savings and investing comes in. So yes, those that are focusing on just one aspect will not do as well as those that are focusing on both. So yes, you need to maximize your career. So try grow in your career as much as you can, but at the same time, try and maximize your savings, save a lot and invest a lot as well.
Oh, that's great. So, um, you're the author of Seven Basic Wealth Strategies, yeah? So I'd like
Correct.
to ask,
Yes.
what inspired you to write Seven Basic Wealth Strategy, and who is it really for?
Yeah. So, Seven Basic Wealth Strategies was written to, all right, I was inspired to write that because I just felt so many books out there didn't give people the basics they needed to learn and understand a lot. Even just what we've been talking about, I've talked about investments for the last few minutes, but even then I had to mention things like, well, saving. The ability to save is different from your ability to invest. So going back to these engineers or professionals that are trying to invest, well, if they can't even save in the first place, there's nothing to invest. Okay. And I also spoke about biases as well. So all these things put together, that's when you can then have a more rewarding and fulfilling life. And those are the basic things in finance. So I felt there are lots of books out there, but nothing really covers the basic things that people should know about and learn about. Hence why I wrote the book. And uh, in that as well, it was to ensure that, well, people have something from a professional, so I'm not someone that has just been uh, I'm not someone that has just, well, I say learned this. I'm someone that teaches this, helps people with this, and it's been my profession for if I look at my total finance profession for just over 13 years now, but financial planning, wealth management, just over 10 years. So I just felt like most people in their profession should be writing more books about that, so people really get to understand a lot. And so that's why I wrote the book.
Great. So, can you walk us through one or two of the core strategies from your book, Seven Basic Wealth Strategies, through the lens of analytical professionals like engineers?
Okay. Yeah. So I'll touch on the first. Let's touch on the first three. And literally, those are the first three chapters. So, first one talks. Yeah. First one talks about having a plan. Okay. So people that want to build wealth or make money, what is the plan for that money in the first place? Okay. Is it to ensure you can then retire early? Is it to give you more money to put in the bank? Why do you want so much money in the bank? Is it to provide for your kids' education? Is it to ensure you can then buy a bigger car, bigger house? So just have a plan. What do you need? How much do you need? Is it possible? Someone that has just saved, um, I'll say $100,000 over the last 5 years, and they want to have $1 million in 10 years. Well, is that possible? Like that's where the plan really helps you understand, okay, is it possible or not? And if not, what else can you do? So having the plan and having that in the 10-year time frame. And why a 10-year time frame is good is because we usually underestimate what we can accomplish in 10 years, but overestimate what we can accomplish in a short period of time, so 1 to 2 years. So that plan really
Mm,
helps you put lots of things in perspective. So that's pretty
yeah,
much first chapter about having a plan, starting with the end in mind. Okay. Second one talked about biases. I kind of mentioned a little bit about that before now. So, but one of the biases that kind of many people have, but don't even know. Maybe they know, but they just don't know how to go about it. Is the herd mentality. So, herd mentality is when you just follow what everyone else is doing because you think that's the right thing. However, when we talk about money management or financial planning, your own financial plan is different from even that of your twin, or that of someone else that has exactly the same situation as you, because your goals and objectives are different. Okay. So I call that the sheep syndrome, where it's like, well, all the sheep are just moving to the one direction without really thinking about what should be done. So that's the second one. Second one really talks about knowing your biases and understanding yourself and what may be holding you back. Okay. So sometimes herd mentality holds you back. I'll give an example. If someone just wants to enjoy their life, and they're not really planning to pass wealth on to the next generation, or they're not really planning to save and invest, compared to someone else that wants to pass wealth on to the next generation or save and invest. This person that doesn't want to should be saving a lot less than this other person, so things like that really um, help them. They should probably be investing in different things as well. Okay, so maybe the um, first person who doesn't really want to plan or pass well on to the next generation might not invest in things like stocks because those are more longer term investments. Okay, and yeah, so that was just one of the biases I spoke about. I think about 8 biases in that chapter, which was good. And then the last one is just cash flow. So, okay, when money comes in, what exactly happens? For most STEM professionals, if you're not running a business, there will be receiving a salary. So, with the salary comes on a certain day and a certain time of the month or week. So, you can really plan around that because once money comes in, then you can put it in your investment, your savings, pay your rent, or pay whatever you have to pay. So just understanding your ins and out cash flow spending plan.
that's great, Victor. So you talked about the herd mentality, uh, when people follow what others are doing. So I'd
Yes.
like to ask, is it the same as FOMO or fear of missing out?
Yeah, very, very, very good question. I think it will have elements of it, but not exactly the same. I think, look, the the FOMO or fear of missing out is more around things that give you present gratification, or rather instant
Mm,
gratification. So it's more like, okay, your friends are out and then you're you're missing out on that. So it can translate to investments as well, because if your friends are investing in things like property, you might then want to do property as well. Well, is that the best thing for you or not? So that's where I would say it has elements, but it's not exactly the same. I think FOMO is more of a social and more instant gratification based versus the herd mentality. Because look, the herd mentality in itself is not bad because, well, it's not that bad. And it's not that bad because let's assume you're investing in property because other people are investing in property is better than not investing at all. So yes, it's not the best thing to do, but you're still a little bit step ahead versus someone that just has FOMO as to their friends being out and they can't be with them.
well, that's quite a very nice illustration. So, a while ago, you mentioned ability to save and invest. So, I like to ask, I mean, say for example, an engineer gets his paycheck. So, out of that, he pays the bills and does what needs to be done. I mean, for the family, buy what he needs to buy to make his life livable. So I'd like to ask, aside those things that he fundamentally has to do, like paying his bills and getting the things he needs to survive, which he has to spend from his paycheck, um,
Mm.
does the other part of the salary not automatically get saved? Do you still need the ability to save again aside? I don't know if you get what I'm saying. When you pay the bills and do what
Yes.
needs to be done, the remnant from the salary doesn't not automatically get saved. Do you still need another ability again?
I'll say the best way for we would save is to break things down. And you know what you've said is, let's assume you get paid once a month and you pay all your bills. The setting bills that don't come in that same month. And I'll give an example. You know, the bill you need to service your car. You're not going to be servicing your car every month. That will probably come once a year. So all of a sudden, you need to be saving for all these other things that come up periodically, but don't come up every month for your salary. Because if you do that, then you're always in a position where you have the money before it's even needed, which is good. Okay, that's one part. The other part as well, you know, when people save, right, it's good for them to think about it as their future money. So it's your money and it's your money to be spent. So now if someone wants to buy a house in 2 to 3 years' time and you're saving for that house, okay, after that period of time, then they don't need to be saving for the house again. So that money can go into something else. So the way to think about sometimes is your different buckets of money you will be saving for. And then look, there should always be that portion where you just put in away for the long term, you know, and when I say long term, to me, this should be money you put in away so you don't have to work after a certain period. You know, you don't need to think about money after that period as well. And that's long term, you know, that's 20, 30 years time for someone that is just starting to save.
I'd like to ask if an engineer listening today wanted to take one action, one right action to improve their finance, what would you actually tell them to start with?
I'll tell them to use percentages for their savings. So it might be, okay, well, put 10% away for the long term. This is money that, look, is not for that house you want to buy in 5 years. It's not for that car you want to buy in 1 year. This is the money you want it to grow and be able to replace your salary or replace your total living expenses in, 10, 20 years time. And then you can have other percentages for other things. And so I'll say that'll be one of the quick tips because I know, as I said, the engineers and those people they like maths and they like being able to use concrete numbers. So using a percentage can be a good way to start.
Yeah, that's great. So, finally, Victor, I like to normally save this one for the last. So,
Okay.
something I normally ask guests that comes to the show, uh, as their last questions here. So, Victor, what does innovation mean to you, and how does it relate to your field as a wealth strategist?
Okay. Yeah. Yeah. I think the first thing that came to mind was getting better. Just getting better to me is innovation in itself, right? Finding better ways to do things, getting uh, better strategies to meet your goals and objectives. Because if we think about lots of the strategies we do now, they were probably not there 10 years ago. So obviously there has been some innovation in that regard. So I would say innovation definitely means to me just getting better, being able to improve, in all aspects.
It's been a nice chat with you, and it's really nice having you on the show today.
Amazing. Thanks for having me, Ezekiel.
So, finally, where can our on the audience connect with you and learn more about your work as a wealth strategist?
Yeah, so I think the best way would be to connect on Instagram. Okay, so the Instagram handle is I am Victor Idoko, and look on there as well. There'll be a link to other sources, but I'll probably just keep it nice and simple because I know most people have Instagram. But look, if you don't have Instagram, I'll be on LinkedIn as well. one of those two would definitely lead you to anywhere else. And look, I might as well add YouTube. We are on YouTube
Yeah.
as well. So it's called Elevate Your Wealth.
All right, Victor. Uh, it was an honor having you on the show today.
Yes, thanks for having me. It's been amazing.
Yeah.